Hello everyone, welcome back to another episode of Parts Talk. Thank you for joining me. I appreciate each and every one of you. Now, the car market bubble has burst and things are getting really interested. So stick around as we are about to break down why car prices are plummeting and the risk dealerships face and what it means for you going into 2024. But first, if you enjoyed content like this, give that like button for a spin and hit the subscribe for more updates. Now, let's get into it. The recent surge in car prices has been fueled by a combination of factors. Limited production due to chip shortages has caused delays, significantly reducing new car inventory. A little known piece, the semiconductor chip, is essential for various functions, from window controls to navigation. And the industry's reliance on these chips, coupled with manufacturing delays and a supply chain crisis, has led to a shortage of new cars, artificially inflating prices. Record low interest rates have played a pivotal role in making cars more affordable. Until 2023, buyers could secure loans with unprecedented terms, with interest rates hitting their lowest level in years. However, this excess demand has led to record high car payments, currently averaging about $753 a month. Auto loans have become the third largest debt category, reaching around $1.5 trillion. People are holding onto their cars longer, mirroring a trend in homeowners choosing not to move due to locked-in low mortgage rates. This ownership trend has further impacted the supply of used cars, contributing to the ongoing market dynamics. Automakers, recognizing the profit potential, have consciously limited supply to maintain control over pricing. Now, let's assess the current situation. Car Gurus reports a 1% decline in car prices in the last 30 days. Tesla's prices in particularly have witnessed a noteworthy 33% decrease, attributing to their category or their strategy of slashing prices to boost sales. And this move by Tesla has set a precedent, influencing other automakers to adjust their prices to remain competitive. And personally, I'm not feeling sad for Tesla. In some aspect, they had it coming. Their direct sales model had some people turning on dealerships, and even Ford was considering selling EVs directly to customers. The Tesla service center model, in my opinion, is another disaster. The traditional dealership model will not go away. It needs an overall with experience and passion, and it is the only way that the dealerships will able to survive in this economic circumstance. Now, interestingly, used electric vehicles now outnumber new ones for sale, marking a notable shift in market trend. And this shift may impact the market share of new electric vehicles. And when looking at specific car segments, crossovers have seen a 7% increase, indicating sustained demand. Now, on the flip side, hatchbacks, wagons, and vans have experienced significant declines, reflecting changing in consumer preferences and the evolving landscape in the automotive industry. Now, dealerships are facing increased risk, especially concerning interest rates. The higher the interest rates, the more it costs dealerships to hold inventory. Dealerships often purchase their cars on credit. So when interest rates are at their highest level in 20 years, every day a dealership doesn't sell a car incurs significant costs. Plus, some lenders are very cautious in extending lines of credit to dealers as cars are sitting longer than average. The auto loan bubble is another concerning factor. Historically, cars don't increase in value, and recent years have been anomalies. Banks and loans issue loans on cars that were selling for higher prices than they should have been, and today buyers find themselves underwater in loans, owing more than their cars are actually worth. Now, car owners are falling behind on payments, and the highest rates on records, reaching 6.1% in September, the highest since 1994. Now, as we anticipate a continued decline in car prices and increase in delinquencies, it's very crucial to understand the negotiating opportunities that are available. Buyers are in a prime position to negotiate favorable deals in the market as it is right now, and the market is shifting. And this is particularly true for those eyeing pickup trucks, which have seen an average increase of 7%, indicating a sustained demand for utility vehicles. Importantly, it's essential to recognize that cars are not investments. They depreciate over time, and this understanding should empower you to make informed decisions in this changing market. If you're in a situation where you can no longer afford your car and can't sell it due to being neck up on your loan, consider reaching out to the bank and renegotiate your payments. It never hurts to ask, and it might have saved both you and the bank from additional financial strain. What I don't understand, with all the information out there in the world, people are still using the cycle of making bad decisions when purchasing a car, and you will see it here in this particular video. Take a look at this.
Have you ever heard of someone with a huge auto loan on a relatively inexpensive vehicle? Ever wondered how they came to owe that much? This is a common issue, and it has to do with something called negative equity. Negative equity happens when you owe more on an item purchased than the item is worth. Since vehicles typically lose value over time, it's common to have negative equity on your car, at least initially. However, negative equity often becomes a problem when you have a longer-term loan of 6, 7, or 8 years. In general, the smaller your down payment and the longer your repayment period, the more it will take you to reach positive equity. There are two main issues with carrying negative equity for a long time. The first has to do with early trade-ins. Let's say you bought a $35,000 SUV with an 8-year loan and 0 down. It might take you 6 years to reach positive equity. But if you decided to trade in your vehicle after just 3 years, for example, you'd still be $5,800 in the red. Now let's say you're buying a new $40,000 vehicle. In order to finance that, the lender will fold your old $5,800 balance into a new loan for a grand total of $45,800 in debt. The second issue with having negative equity is insurance. Say your car is stolen or written off in an accident. Your insurance company says it was worth $20,000, but you still owe $30,000 on it. You may be on the hook for the difference.
In order to protect yourself from a negative situation, you can purchase an endorsement number 43. What that endorsement does is it guarantees that the insurance company will pay you the actual cash value of your vehicle plus any depreciation that's occurred.
I have to pause there. Mind you, this is information coming out of Canada here, but it doesn't matter which jurisdiction you're in. But I'm sure there is a similar clause or something close to it that you can benefit from when you want to go ahead and purchase that new vehicle.
If you find that you don't think that that's enough coverage, there is also gap insurance.
And here's another thing to keep in mind. Lenders can give you a bigger loan, but keep your monthly payments steady by stretching out your repayment period. So make sure you know how much debt you're taking on. That's your Money 123 for this week. I'm Erica Alini.
Now, if you have a much older model car like I do, find a local shop or experienced private mechanic and become a regular. And I'm glad I'm on the after service side of things. Parts and service will always survive. The auto market will continue to face challenges. You have to understand what is going on. And with all the information available, for the love of God, I still can't understand why people continue this cycle of auto loan debt. Again, regular model cars are not investments. So, if you found this information to be helpful, give it a thumbs up and subscribe. Until next time, stay informed and drive safe. Remember to grab a copy of my ebook, The Parts Manager Guide. Please smash that like button on your way out. It will only take you 1.5 seconds to do so. Until next time.